Today's video is sponsored by Incogni, an app that helps you take back control of your data privacy. Indian stocks have been on a tear recently, giving US stocks a run for their money. In this video, we look at the case for and against investing in Indian stocks, but also how to get that exposure in your portfolio if, after doing your own research, you decide to invest. And I'll end by giving you my opinion on investing in Indian stocks. Let's begin with a case for investing in Indian stocks, and we'll focus on demographics. Now here's a projection of the global map, but you'll notice it's not the usual projection. This shows you the size of each country scaled according to its population. And the reason why I'm displaying this is to show you the rather obvious fact that India has a very large population. The reason why that's important, of course, is that it has a very large potential market size. And of course that's going to be reflected in the potential profits of Indian companies that service their domestic market. Now, one of the big worries about investing in developed markets is the very poor demographic trends that we see there. For example, if we look at the dependency ratio, and that's the ratio of older people who are 64 years old or older relative to the working age population, and that's people between the ages of 15 and 64. Now here beside me, you can see the trends of that dependency ratio for various countries. Japan's a bit of an outlier, which has a very high dependency ratio of about 50%. But notice that for all developed countries, that trend is definitely upward sloping. Even for China, in fact, that rapid increase that we see recently is worrying. The real standout in a positive way on this graph is India, where the dependency ratio is only 10% and isn't increasing very rapidly at all. Now that's great news if you're a company that's selling into the Indian market, or if you're looking for staff in India, say, in order to service that increasing demand for your goods and services. So we've seen that India has a lot of people, but if we look at the productivity, this is the amount of GDP generated per person in India, that's still currently low. So if you are going to invest in India today, then you really are getting in at the ground floor. But what you have to hope is that that productivity increases, perhaps to the level of China over your investment horizon. Now that would be a tall order. It would be a six-fold increase in GDP per capita, but if it happens, that could create a lot of upside for the equity market in India. Urbanization is part of that trend. If you look at urbanization in developed markets, it's usually over 80%. China's kind of intermediate between EM and developed markets at about 65% urban, whereas India, it's still the case that only 1 in 3 people are in urban populations. So one way to put it is that if you think that India is going to do a China and very rapidly urbanize and also increase its productivity, then really there's a lot of upside from here. Now there are 2 other cases I think which are very strong for Indian equity, which is to do with market structure and geopolitics. But before we go on to that, today's video is sponsored by Incogni, an app that lets you take back control of your personal data. Now you may not be aware, but as you live your digital life, you're leaving breadcrumbs all over the place, and there are data brokers who can collect information about you and sell it on to third parties. Now that can be used for marketing, it can be used for all sorts of purposes, not all of them potentially are legal. I personally hadn't heard of many of these data brokers, but because of Incogni I do. This is what your dashboard on Incogni looks like, this is mine, and you can see the requests I've made in the past and how those have increased over time. And that's because it doesn't just send one request, it sometimes sends multiple requests to the same data broker. So I can see an activity log showing me which of those data brokers has completed my removal requests. If I look at the detailed review and I sort by severity score, you can see that Sensia, for example, is a high severity data broker. But if I drill into this request, you can see that they were suppressed at the beginning of this year. And the associated risks with that data broker are things like identity thefts, spam, email and calls, data leaks and so on. Now viewers of PensionCraft get a special 60% discount on your annual subscription with Incogni. Just use the coupon code PENSION, or you can go to the link incogni.com/pension, and of course you'll find that link in the description below. And that comes with a 30-day money-back guarantee if you contact Incogni within 30 days of your purchase. Terms and conditions apply. The second compelling case for Indian equity is to do with market structure. Now, this data is as of 2024, and it shows you the market capitalization of various countries' stock markets, and India is in at number 4. So its market capitalization is just under $6 trillion, compared to the US's $54 trillion. That doesn't look very large. But bear in mind that countries like the UK only has a market cap of about $3 trillion. So certainly this is a very large and liquid market, which means that as an investor, the trading cost might be reasonably low. And it's also a sign of the vibrancy of the market itself that liquidity is there in the first place. Another promising thing about the structure of the Indian market is that it's not all focused in one sector. It's often the case, if you look at emerging markets, that they do have that concentration. Now, there are lots of financials in India. So this is the pie chart showing you the breakdown of market structure according to sector. And this is from the MSCI India Index. So financials make up 27% of that market. And while that is the biggest sector, it's by no means completely dominant. There's still good diversification across other sectors. So if you do buy a tracker for the whole Indian market, then you're not just buying huge concentration in one sector, which makes that more risky. And as I said at the outset of this video, India has really given the US a run for its money since the pandemic in 2020. And that really sets it apart amongst all country stock markets, not just those in EM. If you contrast that with China, which repeatedly sabotages its own stock market, you can see the vast difference in fortunes between India, which has surged upwards, and China, which has pretty much gone nowhere. The final case I'll make for Indian stocks is geopolitical. And the first point is that the political system is fairly stable. It is a very large democracy, and that's in comparison to its neighbours, say. It is still an emerging market country after all, but relative to those other EM countries, I'd say that one of the strong points of India is its democracy. It holds regular elections, you get peaceful transitions of power, which isn't even true of some developed market countries, it has to be said. And the Election Commission of India, the ECI, plays a really vital role in safeguarding that democratic process. And it does so by ensuring free and fair elections. And a remarkable fact about the Indian electorate is its size. So in the 2024 election, there were 968 million people who were eligible to vote, almost a billion people. Another key point, I think, is to do with reforms that India is going through as it develops its economy. So that comes in the form of digitalization, also demonetization, and their goods and services tax. All of those have improved transparency in trade and also tax compliance. And then those taxes which are generated can be used to reinvest into things like infrastructure. Furthermore, the Indian government has opened its bond market to international investors, and that's allowed the flow of capital into that Indian market, which is going to benefit India. Also, India has been investing in its infrastructure, in its ports, in its rail system, in its road networks, and that should reduce logistics costs and also the time taken to transport goods across the country. Furthermore, some of my clients are Indian and they tell me about investing in their domestic market and how it's got a real buzz at the moment. So there is a very active domestic investment back into their own equity market. For example, in 2023, domestic investors put about $22 billion into Indian markets. That followed a record investment of $36 billion the previous year. Furthermore, this marks a third successive year when domestic investment into the equity market in India was greater than that of foreign investor flows. So I think that domestic investor base is something that will probably prop up the Indian equity market for many years to come. Many people in India are now investing in mutual funds which invest in their domestic market. But it's not all positive. Now let's focus on the case against Indian stocks. And I think the main one is to do with valuation. Almost by any measure, if you look at Indian stocks, they look expensive right now, more expensive indeed than the United States. So here you can see Robert Shiller's cyclically adjusted price to earnings ratio, which is a measure of expensiveness over time. And you can see that compared to the US, it's considerably more expensive right now. Compare that with the UK and China, well, they're looking really cheap at the moment. Why is that a problem? Well, if people are overpaying for Indian stocks, that usually reduces future returns. That's unless fundamentals, profits, can really tear ahead and justify these very high valuations, which is a tall order. Another case against India, I think, is the restrictions which that society has. And here a useful thing to look at are the freedom indices. So if you're not familiar with that, look up Perth Toll. But the process by which they create this FRDM ETF in the United States is shown here beside me. So they start off with 24 EM countries, that's at the top of this pyramid, and the stocks in those countries. And they screen those countries according to market capitalization. Now, as we've seen, India would almost definitely pass that test. But then they filter by freedoms. What do I mean by freedom? Well, in this case, it's personal and economic freedoms, and they have many different scores for that, 83 quantitative scores, which allow them to rank countries. They also filter out state-owned enterprises, which it has to be said there aren't many of in India compared to China, say. The end result of all that filtering is that India's not listed in the Freedom Index at all. So I personally think that's a bit of a red flag when it comes to investing in a country, particularly in EM. Now, another hallmark of investing in EM, one of the risks, is corruption. And in this case, a recent scandal is to do with Gautam Adani. Here's the story that was in the FT recently, all about that scandal. Now, that really kicked off with a report from Hindenburg, the famous short sellers. And they did really extensive research over a series of years where they spoke to dozens of individuals, including former senior executives of the Adani Group. And they also conducted site visits in many countries, almost half a dozen of them according to their report. Possibly one of the most worrying things that they say in the report is that even if you ignore the findings of their investigation and just focus on the financials of Adani Group, they say that its 7 key listed companies have 85% downside purely on a fundamental basis owing to their sky-high valuations. They also point out that many of these Adani companies have taken on lots of debt. And another red flag that they point out is that 8 of 22 of the key leaders in the Adani group of companies are Adani family members. That places the control of the group's financials and key decisions in the hands of just a few people. So that report was published in January of 2023, but in November of 2024, the US Attorney's Office published this indictment. And this indictment alleges schemes to pay over $250 million in bribes to Indian government officials. And this was allegedly to lie to investors and banks to raise billions of dollars of capital for these Adani companies. Deputy Assistant Attorney General Miller went on to say these offences were allegedly committed by senior executives and directors to obtain and finance massive state energy supply contracts through corruption and fraud at the expense of US investors. So corruption's always a worry when you're investing in emerging markets, and it's often the case that you get these scandals which then blow up and negatively impact sentiment in a particular market. India's certainly managed to shrug it off so far, but we'll just have to see what happens with this criminal case. Now, when you're investing in emerging markets, there are other concerns, of course. These tend to be very volatile markets. The price fluctuations tend to be very large. So a very large allocation to these countries is probably unwise. Furthermore, you're also taking currency risk, in this case with the Indian rupee. Now, that has been devaluing versus the US dollar for some time and other developed market currencies, so that could be a headwind for your investment. It may also add additional volatility if there is a currency crisis. There's also an energy exposure when you invest in India. They import over 80% of their oil, so if we did see energy prices spike again, then that would have a negative impact on Indian stocks. And then finally, I think the state of euphoria which Indian markets currently find themselves in is a worrying one when it comes to investing right now. High valuations, remember, usually mean lower returns in the future. And if we do get escalation of this crisis from Adani or perhaps even other crises, then that could be a problem for that sentiment and could make it disappear. But let's say you did want to go ahead and invest in Indian stocks. How could you go about it? Well, fortunately, there are many funds which give you exposure to Indian stocks. Here, for example, are some which I found on Just ETF, and they're not all expensive by any means. The column to focus on here is the TER column, that's the total expense ratio, and certainly for the two funds at the top, you can see the expense ratio is 0.19%, which is quite reasonable for emerging markets. If you're based in the US, you can use Vetify or ETFDB to do a similar search for ETFs that give you Indian exposure, and again, there are lots of choices here. Why haven't I listed any actively managed funds here? Well, it's certainly the case, even in India, that stock pickers don't tend to do very well over the long term. So if you are paying an active fund manager to try and beat an MSCI India index, say, it's very unlikely that you're going to succeed. Whether you look at large caps, mid caps, or even the bond market, you can see that about 70% of those active fund managers are beaten by the broad market index. In summary then, I think that there's a really compelling case, certainly in terms of demographics and in terms of market structure, for investing in India. What would put me off at the moment is the valuations, which are even higher than in the US. But certainly if there was a pullback in equity markets, I'd certainly have an eye on India, and I'd certainly consider it as part of my market crash shopping list. Because I think over the long term, there's a lot of upside here, potentially. There's a lot going in India's favour over that long term that could push their equity market way ahead. Now don't forget the sponsor of today's video, Incogni, which lets you take back control of your personal data. They've got a special offer which gives you a 60% discount on your annual subscription. You get the 30-day money-back guarantee. Terms and conditions apply. And if you want to find out more about that, just go to the link in the description below. And, as always, thank you for listening.